Two of the biggest companies on planet Earth just reported earnings. They beat the numbers. More sales, more cloud growth, more cars out the door. And Wall Street's response? Tesla down 12%. Alphabet down 6%. Hundreds of billions of market value gone. On good news. So what spooked the market? One word: artificial intelligence. Let me show you exactly what happened. Here's the backdrop. Wednesday, July 22nd, after the closing bell, Alphabet, that's Google's parent company, and Tesla both dropped Q2 numbers. On paper, strong quarter. Google's cloud business accelerated. Tesla delivered more vehicles and beat on revenue. Deliveries, check. Revenue, check. Cloud, check. A year ago, that's a green day. Champagne. Everything pops. But in 2026, different animal. Because investors have stopped asking, how much did you make? Now they're asking, how much are you spending? And the answer is terrifying them. Let's talk real numbers. This is the part that matters. Alphabet just guided its 2026 capital spending. That's money for AI data, chips, infrastructure towards around $200 billion. Some reports pushing it to 205. Read that again. $200 billion on a single year on AI. And Tesla Capex, north of $25 billion, nearly triple what they spent last year for new factories, AI infrastructure. Here's the kicker on Tesla's free cash flow: negative $1.1 billion deficit a quarter. Year ago, it was positive. That's the whole story right there. The companies are pouring money into AI's arms race faster than AI is paying them back. Goldman Sachs just flagged that nearly $489 billion in AI-related debt issued just this year alone. For big tech company, that's a huge chunk of it. It's a huge percentage. The market looked at that and said, show me the returns. Why this matters to you. Now, here's why you should care even if you don't own a single share of Google and Tesla. These are the biggest, most owned stocks in America, and they're in your index funds, they're in your 401ks, they're in your retirement. And when the market's biggest names get punished for spending, even while growing, that tells you something about where we are going in this market cycle. The AI trade is maturing. The easy phase is over. For many years, any mention of AI stock, just every market went up. Now, investors want proof, profit, return on all that spending. That's not a crash, and that's not a reason to panic. It's a market growing up and asking the harder questions. And honestly, that's healthy. Discipline over hype, substance over story. That's how wealthy actually gets built. Slowly and on purpose. These are my takeaways. Here are my takeaways, and you can hold me to it. Everybody's chasing the shiny thing, the next AI winner, the stock that can't lose. But the market just reminded us of an old truth. Spending is easy. Stewardship is hard. And the question is never, are they growing? The question is, are they growing wisely? Are they disciplined with what they've been given? That's true even for a $1 trillion company, and it's true for your household budget this month. If this helped you see the markets clearer, hit the subscribe button, drop a comment. Are you buying this dip or are you sitting tight? I read everyone's comment. Stay wise, stay steady, and I'll see you on the next one.